So if you are holding, say, 100,000 euros in cash right now, and assuming you keep it perfectly safe, locked at a bank vault somewhere, you are mathematically guaranteed to lose more than half of its purchasing power over the next 40 years.
Yeah, it's literally a mathematical certainty.
Right. It is basically a silent, completely legal theft of your wealth. And today, we are building a lifelong playbook to stop that theft. Frankly, we're trying to completely re-engineer the way you interact with capital from this day forward.
Welcome to a brand new deep dive into your financial lifespan.
Glad to be here.
Our mission today is to construct a really comprehensive roadmap for you. We want to connect the mechanics of your monthly grocery budget all the way to, surviving global market shocks, right up to the architecture of your actual retirement portfolio.
And we're pulling from a massive stack of institutional research to build this roadmap for you. We've got data and strategic frameworks from Integrity Asset Management, Kramer Wealth Managers, Vanguard, JP Morgan Asset Management, and HSBC UK.
It's a heavy lineup.
It really is. And the objective isn't to just, look at these as isolated financial theories, but to synthesize them into one continuous timeline. Because building lifelong wealth requires recognizing that the micro decisions you make with this week's paycheck, they are permanently tethered to the macro environment of global markets decades from now.
Okay, let's unpack this. Because before we can even debate the merits of, say, active versus passive funds or the resilience of a 60-40 portfolio, we kind of have to look at the ground floor of capital allocation.
The day-to-day stuff.
Exactly. Without a mechanism to capture cash flow today, there's literally nothing to manage tomorrow. And HSBC UK provides this behavioral framework for this that most people know is the 50-30-20 rule.
Right, a classic.
Yeah, so 50% of your income is allocated to fundamental needs, so housing, utilities, baseline food. Then 30% is directed to wants, which dictates your current lifestyle and discretionary spending. And then that final 20% is strictly walled off for the future, meaning debt reduction, savings, and investments.
And, the brilliance of that framework for anyone managing capital isn't actually in the specific percentages. Those are essentially arbitrary benchmarks.
Well, right. It's not a rigid law.
Exactly. The real value lies in the behavioral economics of forced awareness. When you sit down and mechanically divide your trailing 3 months of expenses into those 3 rigid categories, you're performing an internal audit on your own lifestyle creep.
Which we all suffer from, right?
Oh, absolutely. Human beings naturally expand their needs category to consume whatever capital is available. By aggressively fencing off that 20% for the future first, you force the 50% and 30% categories to compete for the remaining resources.
Yeah, rather than the future just taking whatever happens to be left over at the end of the month.
Exactly. It completely flips the priority.
I always think of it like managing a corporate balance sheet.
Yeah.
The 50% for your needs is purely operating expenses, right?
Yeah.
The absolute baseline required just to keep the lights on and the doors open.
Yeah, keeping the machine running.
Right. And the 30% is your culture and employee retention budget. It's the discretionary spending that prevents you from burning out and keeps the whole operation actually enjoyable. But that 20% future bucket, that is retained earnings.
Oh, I like that comparison.
It is the capital you are stockpiling for future acquisitions, weathering inevitable industry downturns, and for long-term compounding.
Yeah.
If a corporation constantly spent its retained earnings on executive lunches, the shareholders would revolt.
They demand a new CEO.
Exactly. Yet individuals do this to their own personal balance sheets every single day.
That corporate analogy actually perfectly isolates the failure point for most retail investors. They treat their personal balance sheet as a casual day-to-day operation rather than a multi-decade enterprise.
Yeah, that's a great way to put it.
And the research from Kramer Wealth Managers illustrates exactly what happens when that 20% retained earnings bucket is chronically underfunded. The data shows people falling into this cascade of highly predictable decade-by-decade traps as they age.
Yeah, the Kramer data breaks this down beautifully. Like, in your 30s, the primary psychological trap is the illusion of infinite future cash flow.
Right, you think you have forever.
Exactly. Your earning curve is steepening, your career is accelerating, and so you delay aggressive investing, assuming you'll just, catch up when you are making more money in your 40s.
Which is a huge mistake.
Massive.
Yeah.
Because by doing so, you completely forfeit the steepest part of the compounding curve. Then as you hit your 40s, the trap pivots to the sandwich generation squeeze.
Which is incredibly stressful.
Oh, yeah. You are simultaneously trying to pay off a mortgage, fund a child's college education, and maintain a certain lifestyle, which just pushes retirement planning completely off the table.
And then the 50s hit.
Right. And in your 50s, the trap becomes the sudden, terrifying realization of healthcare costs. Those are routinely abstracted and underestimated until they are staring you right in the face just before retirement.
It really is a systemic misallocation of capital, and it's driven by the fact that immediate, visible problems always feel more urgent than distant, invisible ones. I mean, the pressure of a tuition bill arriving next month will invariably override the conceptual need to fund a retirement that is 20 years away.
Okay, so what does this all mean for someone listening who is currently in the thick of that? Because I have to play devil's advocate on the 40s dilemma here.
Go for it.
If you are 45 years old, looking at university tuition costs for your kids and a mortgage on your primary residence, it seems incredibly rational to deprioritize retirement. Like, how can a financial framework logically demand that a parent divert capital away from their child's immediate education to fund an account they won't even touch until 2045?
Well, if we connect this to the bigger picture, capital markets and economic realities simply do not care about parental obligation.
Coach, but fair.
It's harsh, but it's true. The underlying mechanism here is the availability of leverage. We operate in an economy where you can borrow capital for almost anything that has a perceived future return.
Right.
A student can take out loans to finance their education against their future earning potential. You can take out a mortgage against the physical asset of your home. But the credit market draws a hard line at aging.
Wait, what do you mean?
There is absolutely no bank, institution, or government entity that will underwrite a loan to fund your daily living expenses in retirement.
Oh, wow. Yeah. You can finance a degree, but you cannot finance your retirement.
Exactly.
That cuts right through the emotional noise of the 40s dilemma. And it really hammers home why failing to aggressively defend that come percent future bucket is so catastrophic. The Craver data highlights our failure to estimate costs, but JP Morgan Asset Management brings in the other variable we wildly misjudge, which is time.
We are terrible at predicting time.
Right. According to their longevity research, a 65-year-old couple today has a 50% probability that at least one partner will survive to age 90.
And that statistic forces a massive paradigm shift in how we view risk. I mean, for decades, the financial industry treated age 65 as a finish line.
The golden watch, right?
Yeah, you cross it, you pull your chips off the table, and you move into safe cash and short-term bonds. But if your capital has to survive an entirely new 25-year lifespan, moving to cash isn't safe at all.
Because of inflation.
Exactly. It is the riskiest move you can make because it exposes you entirely to inflation.
Which brings us back to the silent theft we opened with. The JP Morgan inflation data is just ruthless.
It really is.
If central banks simply hit their modest 2% inflation targets over a 40-year period, that 100,000 euros shrinks to the equivalent of 45,000 euros in purchasing power.
More than half. Gone.
Yeah. But even that feels sort of theoretical until you look at the recent historical performance. Between the years 2000 and 2025, cash generated a negative 0.6% annualized return in real terms.
You are actively moving backward. The mechanism of inflation is that fiat currency is constantly being diluted by monetary expansion. A dollar or a euro is essentially a melting ice cube.
That's a great image.
The only way to preserve wealth is to convert that melting currency into ownership of assets that actually benefit from the inflation, meaning businesses that can raise their prices to match the expanding money supply.
Holding cash is basically like keeping a block of ice in the trunk of a hot car. It provides this psychological comfort because it feels tangible. Right?
Yeah, you can hold it.
You can look at your bank balance and see the number isn't going down. The ice is still sitting there. But the environment around it guarantees that its actual utility, like its ability to cool anything down, is evaporating minute by minute.
Absolutely.
The only way to stop the melting is to put it into a refrigerated environment where it can actually accumulate. And in financial terms, that environment is the compounding engine of the equity markets.
And compounding is really just the mathematical translation of human economic progress. When you invest in the market, you aren't just betting on numbers moving on a screen.
Right, it's not a casino.
No, you are buying fractional ownership of millions of human beings waking up every day, innovating, generating profits, and reinvesting those profits to grow their enterprises. And JP Morgan provides a stark example of the leverage time applies to this engine.
What's the example?
If you deploy 5,000 euros annually into the market at a...
And the data gets even more extreme when you factor in the mechanics of dividend reinvestment. Like, we all know that choosing to take dividend payouts as cash instead of automatically reinvesting them creates a drag. But over a 40-year timeline, failing to reinvest those dividends effectively splits your total potential return in half.
It acts as an anchor on the compounding curve. So, we have established that cash is a guaranteed loss of purchasing power and that aggressive early market participation is the only mathematical countermeasure.
Right.
The strategic question for you listening then becomes one of deployment. How do you actually construct the vehicle that captures this growth? And for that, we transition into the analysis provided by Vanguard, focusing on the deep structural differences between active and passive management.
And let's bypass the basic definitions here, right?
Right.
Anyone listening to this deep dive knows the difference between an index tracking ETF and a mutual fund run by a portfolio manager.
Sure, we don't need to rehash that.
What we need to dissect is the strategic deployment of both. Because the Vanguard research introduces a data point that seems completely counterintuitive to the modern index everything mantra.
It really surprised me.
Yeah, their data reveals that during the period studied, a massive 79% of active stock fund managers actually outperformed their respective benchmarks.
This raises an important question, and it strikes at the core of portfolio theory. If 4 out of 5 active managers are beating the market on a gross basis, why has the institutional and retail world seen trillions of dollars migrate away from active managers and into passive index funds?
Right.
The answer lies in the friction costs of capturing that outperformance.
Here's where it gets really interesting. Because on paper, passive indexing looks completely foolish if 79% of the professionals are actually winning.
It seems like a no-brainer to go active.
Exactly. But Vanguard points out a massive structural trapdoor, which is tax drag and manager risk. When a portfolio manager is actively trading to beat a benchmark, they're constantly triggering taxable events.
Every trade matters.
Right. So if an active fund beats the S&P 500 by 1.5% in gross returns, but their high turnover ratio distributes short-term capital gains that generate a 2% tax drag on your portfolio, you have taken on significantly more risk to mathematically lose money compared to a passive index.
The friction costs destroy the alpha. An active manager has to outtrade the market not just to win, but to overcome their own management fee, their trading costs, and the resulting tax liability they force onto the investor.
It's a massive hurdle.
It is. And this is the exact mechanism that makes passive index funds so violently efficient for the core of a portfolio. Because an index fund only trades when the underlying index changes, it has near zero turnover.
It means no tax surprises.
Right. It rarely distributes capital gains, allowing your capital to compound completely unbothered by tax friction until you actually choose to sell.
But the Vanguard analysis doesn't demand ideological purity here. They're not saying active management is inherently toxic. It's all about asset location.
Location is everything.
Yeah. If you want to deploy capital into highly inefficient markets, say emerging market small caps, where an active manager's research can actually exploit pricing errors, you don't put that high turnover active fund in your standard taxable brokerage account.
That would be a tax nightmare.
Exactly. You isolate it inside a tax-advantaged retirement account. You use the passive ETFs to form the broad tax-efficient core in your taxable accounts. And you use active managers as surgical satellites, where the tax drag is neutralized by the account structure.
It is about optimizing the environment for each strategy. But, regardless of whether your capital is deployed in passive indexes, active funds, or a hybrid of both, the entire architecture will just collapse if it isn't structurally engineered to survive systemic shocks.
We need defense.
Exactly. We have to address the defense mechanisms, which brings us to the research from Integrity Asset Management and the resilience data from JP Morgan.
Integrity Asset Management really lays out the structural engineering of diversification. And we aren't just talking about buying a few different tech stocks and calling it a day.
No, that's a common trap.
True diversification means deliberately acquiring non-correlated assets. You are intentionally building a portfolio where certain components are expected to underperform when others surge.
Right, they move independently.
You want equities for growth, bonds for ballast, real estate for inflation hedging. You want exposure to different geographic economies, so a regulatory crackdown in one hemisphere doesn't just wipe out your entire net worth.
And the psychological hurdle with true diversification is that it guarantees you will always be disappointed by a portion of your portfolio.
Always. Something is always losing.
There is always going to be an asset class dragging down your overall return in any given year. But that intentional friction is what provides the structural integrity to survive periods of extreme market stress. And JP Morgan's data on volatility illustrates exactly how severe that stress can be. The average intra-year drop for the broader market is 14.6%.
I just want to let that number sink in for a second. If you have 500,000 euros invested in an entirely average, historically normal year, you should expect to log into your account at some point and see that you are down 73,000 euros from the peak.
That's hard to stomach.
It is. But that level of volatility isn't a glitch, it is the entry fee. It's kind of like hitting severe turbulence on a transatlantic flight. When the plane suddenly drops 3,000 feet, your amygdala screams at you that you are in mortal danger.
We're going down.
Right. But the aerospace engineers designed the 747 specifically to flex and absorb those exact atmospheric stresses.
What's fascinating here is the fundamental inseparability of risk and return. The market premium, the historical returns that outpace cash and inflation, exists exclusively because of that turbulence.
If it was safe, it wouldn't pay.
Exactly. If the market never dropped 15%, it would be considered a risk-free asset, and it would yield the exact same return as a government treasury bill. The volatility is the source of the compounding. And despite experiencing an average 14.6% mid-year plunge, 29 of the last 40 years still finished the year with positive returns.
Yet human nature dictates that when the plane hits that turbulence, passengers try to open the emergency exit mid-flight.
Which is the worst thing you can do.
JP Morgan highlights the devastating impact of market timing. Investors notoriously sell off their assets when the market is near its absolute bottom, effectively locking in their paper losses and entirely missing the subsequent recovery.
And the historical resilience of a structurally sound portfolio makes attempting to time the market mathematically absurd. When you look at the most severe geopolitical and economic shocks of the modern era, the aftermath of 9/11, the 2008 global financial crisis, the immediate crash of the COVID-19 pandemic, a standard 60-40 portfolio of stocks and bonds outperformed cash 70% of the time over the subsequent 12-month period.
Just 1 year out.
Yep. And if you extend that horizon to just 3 years post-crisis, the 60-40 portfolio outperformed hiding in cash 100% of the time.
The structural engineering of a diversified portfolio absorbs the shock and accelerates the recovery faster than any other available option. JP Morgan takes that data all the way back to 1950. Across more than 7 decades of wars, assassinations, oil embargoes, and financial meltdowns, there has not been a single 10-year rolling period where a broadly diversified 50-50 portfolio yielded a negative return.
Think about that. 7 decades.
Even over the last 10 years, which felt like a relentless barrage of unprecedented global events, a diversified portfolio delivered an annualized return of roughly 6%.
The math of recovery is ironclad, provided you do not interrupt it. So I have to ask you listening right now, what stands out to you in all of this data?
Yeah, what's your breaking point?
Exactly. When you inevitably face a macroeconomic shock and your portfolio bleeds 15% in a matter of weeks, are you mentally prepared to sit on your hands and do absolutely nothing? Because all the tax optimization and compounding math in the world is entirely useless if you lack the psychological discipline to execute the playbook during a panic.
That is the ultimate bottleneck, isn't it? The math is solved, the behavioral psychology is the variable.
It always is.
Let's look at the absolute masterclass of a roadmap we have synthesized today. We started at the ground floor, deploying the 50-30-20 framework to audit our cash flow and ruthlessly defend the 20% retained earnings bucket.
Setting the foundation.
We mapped the psychological traps of the decades, recognizing that you cannot borrow your way out of retirement. We examined the relentless decay of inflation and countered it with the exponential mechanics of compounding.
Putting the capital to work.
We navigated the friction costs of active versus passive management, locating our assets for maximum tax efficiency. And finally, we engineered a diversified shield capable of absorbing 15% intra-year drops while remaining structurally sound over every 10-year period since 1950.
It is a playbook that shifts you from being a passive participant in the economy to an active architect of your own generational wealth. The most empowering reality of this deep dive is that your financial lifespan is not dictated by luck.
Not at all.
It is dictated by early deployment, structural efficiency, and uninterrupted discipline.
But before we sign off, there's one final provocative reality I want to leave you with. Something that challenges the very foundation we just built.
Curveball.
Yeah. This entire playbook, every shred of JP Morgan and Vanguard data we discussed, relies on the assumption that the next 50 years of market behavior will roughly mirror the last 50 years.
Right. Historical precedent.
But look at the sheer velocity of the modern horizon. We are entering an era dominated by algorithmic high-frequency trading, artificial intelligence managing institutional capital, and the frictionless, instantaneous fractional investing of retail apps.
The fundamental mechanics of price discovery and market liquidity are being rewritten in real time.
Exactly. The speed of capital is accelerating. So the question you have to ask yourself isn't just whether you can follow the historical rules, it's whether the historical rules of the 20th century will actually hold true for the back half of the 21st century.
That's a huge unknown.
Will a 60-40 portfolio still provide the ultimate shock absorption? Or are we entering a totally new paradigm where time-tested asset allocations will themselves need to be radically redefined?
Something to really think about.
Keep an eye on how the machinery of the market evolves, but never lose sight of the foundational math that governs the capital in your pocket today. Stay disciplined, embrace the turbulence, and thanks for joining us on this deep dive.